Right now, let's bring in Callie Cox of eToro USA Investment Analyst and Michael Puglisi, Wells Fargo Senior Economist. Let's get right into analyzing the Fed's decision, making a decision to raise rates by 25 basis points. First of all, what's your initial takeaway from these results? We'll start with you, Callie.
Sure. So I'm not surprised by the rate hike. I think that was market consensus, and it certainly was our consensus going into this meeting. But I think it just shows just how serious the Fed is about getting inflation down, and the fact that they're still waiting on evidence that the economy is, potentially weakening enough to see that inflation come down, or at the same time, offer up a reason to start pausing rate hikes. It's just more of the same. But I do think Powell, once the press conference starts, will lean in on the dovish language, lean in on the megaphone a little bit to make this feel a little bit smoother.
Mike, there were no dissents despite that turmoil that we have certainly seen creep back into the banking sector this week. What does that signal to you?
I think it signals that Chair Powell has managed to find some consensus on this, which is really remarkable when you think about the journey we've been on over the past year. So we started with a 25 basis point rate hike that went to 50, went to 75, became multiple 75s. And now we've sort of reversed it, right? We've gone from 75 to 50 to a couple 25s, and now potentially a pause, although I think they'll keep their options as flexible as possible heading into June and beyond. But I think it's just remarkable that they've managed to find that level of consensus. But that being said, they have done quite a lot over the past year. 500 basis points of tightening in just over 12 months. Fed's been reducing its balance sheet for close to a year now. And you're starting to see some of those effects, both in the real economy and also in the financial system, building up from all that tightening.
Well, I want to ask for your expectation. So obviously we have the statement out now, but later we'll have the press conference. What are you looking for to hear from Powell? It seems like so far from the statement that the door is open potentially for further rate hikes, which we didn't expect coming into this. And that may just be the typical Fed stance of kind of balancing the scales and not completely going one way or the other with regards to being too hawkish or too dovish. Callie, what's your base case expectation coming out of this? I know the terminal rate we were expecting was this range between 5 to 5.25%. But what are you expecting now?
Well, I think Powell's words are much, much more important. And I'd expect to see something similar to what we heard in March. Again, we see a rate hike, but then Powell almost couching that rate hike with language around being flexible and understanding and really acknowledging what's going on. I mean, when you think about the Fed's mandate, obviously it's to control inflation and promote healthy employment. And I think the Fed, by initiating a rate hike, of course, says that inflation is still much too high. There's more work to be done. But I think if Powell acknowledges the fact that the job market is still strong, there's still a bit of cushion there that could ease markets into this. And I think he'll thread the needle.
Mike, do you want to chime in on that?
Yeah, and the way I think about it is I think the most likely outcome is this is the last rate hike of the tightening cycle, but that's not a guarantee. If we're sitting here 3 months from now or even 6 months from now and inflation has not slowed further like the Fed's looking for and economic growth remains strong, the labor market remains very tight, then I wouldn't rule out the possibility that there could be 1 or 2 more rate hikes. But I think the most likely scenario at this point is last rate hike, quantitative tightening continues for at least a little while longer, and they sit and the extended pause allows the medicine to take in the coming months and brings inflation down further before eventually the Federal Reserve pivots towards rate cuts probably, in 2024, the very end of this year.
Mike, what does all this then mean for the risk of recession? Because yes, the Fed did omit that language that everyone was looking for just in terms of signaling more rate hikes ahead, yet they still, though, did raise by 25 basis points given in an environment that's so uncertain. Is this more of a sure thing that maybe we will see a recession in the second half of the year?
No, I don't think so. I think, it shows that the Fed has been serious about dealing with inflation, but also flexible, right? And that they responded by accelerating the pace of tightening last year and also by slowing it down from 75 to 50 to 25 and now potentially a pause. So, of course, there's still a lot of uncertainty out there in the financial system and the economic outlook. But I think the Fed is showing you that they're going to try to adapt to conditions as they warrant as best they can in real time, which is always very challenging when there's, so much uncertainty about the economic and financial outlook.
And I want to ask, Callie, let's bring you back in here and just talk about the issues that we've seen in the regional banking sector and the Fed's stance on that. What do you think, has the Fed done enough, and is it really taking into consideration potential problems that may still exist in that sector?
Well, obviously the Fed is concerned about it. That's why they've stepped in and provided emergency lending to these regional banks, these small and mid-sized banks. At the same time, I agree. I think in the statement today, the Fed says, that we think the banking system is safe and sound for now, which tells me that they think that this is a one-off. And, I agree. I don't think it's a crisis here. I don't think that the Fed is making light of it for sure. I think they're stepping in as needed. But right now, basically what we're seeing is a scare among smaller banks and not this full-fledged loss of confidence in the system, which is where I think this could tip over into crisis mode. But I think the Fed is straight down the middle with this, really acknowledging the fact that there are issues here and there and that the rate environment caused them. But at the same time, it's not the kind of credit crisis we've seen in recession past.
Yeah, and Callie, when you take a look at what the Fed almost seems to be signaling at this point, they're confident with where the banking sector is today. They're confident in the strength of the banking sector, very similar to what we heard from a number of CEOs earlier this week. Yet when you take a look at the market's reaction this week, it seems like investors are interpreting it a different way. Why do you think that is?
Well, I think it's all about, thinking about what could be versus what is. And obviously, if the dominoes keep falling, if we do tip into a crisis, there is that breaking point where we could see tightening lending conditions really weigh on the economy. So far, so good. I haven't seen much evidence of that. We have seen some stats here and there suggesting that it has been harder for small businesses to get loans and that lending has dried up a little bit. But I think that's what the Fed is keeping an eye on when it thinks about its dual mandate, controlling inflation and, promoting healthy employment. It's thinking about, how easily borrowing is going through the system. And right now there have been some hiccups, but at the same time, it's really, been a pretty free flowing, ecosystem. So I agree. I think it's right to look at these on a case by case basis.
So, Mike, I want to ask you a question. So this has been consecutive increase after increase after increase with regard to the Fed's move. I mean, this has been the fastest clip we've seen increases in 4 decades, right? And I want to ask you it's obvious that the Fed, some people have used this language, is trying to break the economy, basically, the situation with regard to the job market. It has a dual mandate, 2% inflation target, and the monitoring the employment picture and making sure it achieves a certain level, right? Do you think the Fed, where it is today, this is what we were expecting. If another rate hike comes down the pike by their next meeting, would it be a step too far, a bridge too far?
I think it just depends on the data. I mean, you look at the next 6 weeks and the Fed has a lot more data coming in. 2 more employment reports, one of which is coming up on Friday, 2 more CPI reports, lots of other data that's still to come in. And I think it depends on what that looks like. If you've added 200,000 or 300,000 jobs a month, core inflation still running at a 5% plus pace, then I think they're going to be in a situation where they may want to weigh another rate hike. But if the data continue to slow down, job growth slows further and inflation slows further, then they probably feel pretty good about continuing to sit there and just pause for the time being. But that's why I stressed at the beginning, I think it's about maintaining maximum flexibility and trying to buy yourself some time between now and their next few meetings to assess how much that very rapid pace of tightening has had an impact on economic growth, job growth, inflation, and all the key measures that the central bank worries about.
Callie, what should investors do right now, given all this? How should they be positioned?
Hey, that's my favorite thing to talk about. I mean, right now, I think it's all about your barbells, and we've been saying this for a while, but it's smart to remain defensive here. Obviously, there are a lot of worries out there. Growth is slowing. We're not sure how big the impacts could be from First Republic and Silicon Valley Bank and the other failures we've seen. But at the same time, it seems like the pain trade in the market is higher. And there's a lot of risk in missing a rally that just won't quit. So we're recommending, if you're looking at risk, look at those bigger, more durable companies that could make it through a recession if we hit one. But at the same time, remember that stocks could fall 5-10% from here. And if we hit a recession, we'd expect the market to take out the lows again. So be prepared for either scenario.
All right, Callie Cox, Mike Puglisi, always great to get your perspective. Thanks so much